What is an assessment year? What is a previous year? Who are included in person? Who is regarded as SSC? How to charge tax on income?
So this is all we are going to understand and many more. So what is assessment year? What is the previous year? All the persons are subject to pay tax. So who are considered as person? Okay. Who is regarded as assessee? That means the person who pays tax under the Income Tax Act. He is called the assessee. So we are going to understand the definition of assessee and how to we are going to charge tax on income. Then, Kishore.
What is regarded as income under the Income Tax Act? What is gross total income? What is total income and how it is computed? What is agricultural income? What is difference between exemption and deduction?
So we are going to understand all this, okay? And then further,
What are capital and revenue receipts? What is capital and revenue expenditure? How far method of accounting is relevant in computing income? Problems on basic concepts.
so these are the concepts which we are going to understand. What are the capital and revenue receipts? So normally the revenue receipts are subject to income tax and not the capital receipts. So we're going to understand more about them. What is a capital and revenue expenditure? Okay. So how far the method of accounting is relevant in computing the income. So there are various methods of accounting which we adopt. It's called cash accounting or accrual accounting. Okay. So we are going to understand how it impacts the income tax and what method is recommended by the income tax authorities. Then some problems on the basic concepts. Okay. So first is what is an assessee, which is given under section 2. Can you read this?
Assessment. What is an assessment year? Assessment year means the period starting from April 1 and ending on March 31st of the next year. Thus, the assessment year 24-25 commences on April 21-24 and ends on March 31, 2025.
Sir, Anuj is in waiting. Can you
Okay.
accept his?
Who is waiting? Anuj.
Yes, sir. Tejas as well.
Oh, multiple people view. So I'm just admit all. Okay. So Anuj has also joined. So be on time. We have just started the lecture. Tejasvi,
Yes, sir.
Anuj,
Good morning, sir.
good morning.
Yes, sir. Sure. Sir.
Okay. Somebody else, Sankalp is also there. So okay. Okay. So we are going to start. Okay. So this is the first slide we are doing. What is an assessment year? Okay. So assessment year means the period starting from 1st April and ending on 31st of March of the next year. That means the next year. Okay. Like, now we are having, the period already 27th of March or 28th of March of 2024. So the next year, that means from 1st April till 31st of March will be the assessment year. For example, the assessment year 2024-25 commences on 1st April 2024 and ends on 31st of March 2035. So that means the assessment year is yet to begin. So after a couple of days, the new assessment year will start. Income of the previous year of an assessee is taxed during the next following assessment year. Okay, that means the income of this year, which is 23-24, the 23-24 is the 1st April 2023 till 31st of March 24, 1 year, which is called the previous year. The income of this year will be, taxed in the assessment year 2024-25 at the rates prescribed by the relevant Finance Act. Okay, so every year the Parliament passes the Finance Act during the budget time. Of course, this time we didn't have any budget. It was budget will be passed after the regular budget will be passed after the elections are over. So now in that case the rates which has already been prescribed earlier will become applicable for the previous year, which is already about to end. So income of previous year of an assessee is taxed during the next following assessment year at the rate prescribed by the relevant Finance Act. So one thing is very important: the Income Tax Act doesn't give the rates. It is the Finance Act which gives the rate at which the person is going to pay tax next year. Okay, so yeah, is it clear?
Yes, sir.
So Kishore,
Income, what is previous year? Income earned in a year is taxable in the next year. The year in which income is earned is known as previous year, and the next year in which income is taxable is known as the assessment year.
So it's very clear that there is always a previous year and an assessment year. So at the moment we are having 2023, which starts from 1st April 2023 and ends on 31st of March 2024, which is about to end. So that's the previous year. So whatever money which we have earned during this year will be assessed, in the next year, which is called the assessment year, which is called 2024-25. So for the previous year 2022-23, the assessment year is 24-25. 23-24 is the previous year, and 24-25 is the assessment year. Okay.
Yes, sir.
So let's take an example.
Provisions illustrated. Income earned by an individual during the previous year 23-24 is taxable in the immediately following assessment year 24 and 25 at the rates applicable for the assessment year 24-25. Similarly, income earned during the previous year 24-25 by a company will be taxable in the assessment year 25-26 at the rates applicable for the assessment year 25-26. The rule is applicable in all cases.
Okay. So, however, there are some exceptions. So, we are going to understand that. So, I think the provision has been well illustrated. So, is there any doubt here? What is written? Like, for if an individual earns income during the previous year, 2023-24, his income is going to be taxed and assessed in the year 2024-25 at the rates which have been given for the assessment year 2024-25 by the Finance Act. Okay. So,
and the rate of 2024-25 will be given in the budget of FY25 only.
Just hold on. हाँ, क्या बोल रहे थे किशोर?
सर ये जो 24-25 का जो रेट्स होगा वो ये
जो फाइनेंस एक्ट ऑफ द बजट व्हिच वाज पास्ड जस्ट रिसेंटली, which was not a full budget, which was the full budget will come up in the next after the elections. So, but Sitharaman has already said that whatever the rates which they have been, already, will be applicable, which was passed in the last assessment year. So, last year के budget वाला जो rate है, वही budget rate apply होंगे. So, that has been already been passed in the interim budget, which was presented in the month of February this year. Okay.
Okay.
Fine. So, uniform previous year. Read this.
Uniform previous year. All SSCs are required to follow financial year, that is April 1st to March 31 as previous year. This uniform previous year has to be followed for all sources of income. However, it is not necessary that one should maintain books of accounts on the basis of financial year.
So, there is always a uniform previous year. So, for tax purposes, there is always a uniform previous year which starts from 1st April and ends on 31st of March. Now, we may or may not be required to maintain books of account. If we are a company or doing business, then we are required to maintain the books of account under certain conditions. Okay, so let's understand them.
For the assessment year 24-25, income earned by X Limited during the previous year, that is 23-24, April 1st to 31st March 24, is chargeable to tax. It is, however, not necessary that X Limited should maintain books of account on the basis of financial year, that is April 1st to March 31st.
Now, companies, they can maintain the books of account either calendar year or financial year, whatever they can follow, any this thing year, but they will be assessed for the income tax purposes. The assessment year is going to be 1st April 2023 to 31st of March. Okay, fine. So let's understand this.
X Limited may maintain books of account on the basis of any other year, but the purpose of income tax, income of the previous year 23-24, that is April 1, 23 to March 31, 24, is taxable for the assessment year 24-25.
So for the tax purposes, he has to pay tax from 1st April 2023 to 31st of March 2024. So that means for the tax purposes, his previous year will be considered as a financial year. He may adopt a calendar year, okay? But for taxing purposes, the year will be treated as beginning from 1st April 2023 and ending on March 2024. So we understand this in an example.
If X Limited maintain books of account on the calendar year basis, taxable income shall be determined as follows.
Okay, so let's understand this example. Suppose a company X is maintaining, books of account on the basis of accounting year, which is calendar year. Okay, which is given the first column 2022, 2023, and 2024. So this is the calendar year. Income as per books of account, which is based on the calendar year. For 2022, the income was 60,000. For 2023, it was 70,000, and for 2024, it was 90,000. So now we will have to break up into quarter-wise breakup of income. So the quarter-wise breakup is given. The income from January to March, for 2022 was 18,000, and April to December, it was 42,000. Okay, so from January to March, and from April to December. Fine. So this is given. From 2023, the income was 70,000 and the breakup is given. So what we'll do, we'll convert that into the assessment year for 22-23. Previous year is 22-23. Income will be 68,000, which is basically the 42,000 previous year, April to December, and January to March. So this will become, a full previous year of 22-23. Okay. So this is from 1st April to 1st April 2022 to 31st of March 2023. So what we have done, we have ignored this January to March. So we have taken this April to December, 42,000 is the income, and added this with 26,000 of the next year calendar, the first quarter. Okay. So the 3 quarters of this year and 1 quarter of this year will make the previous year. So his income will be considered as 68,000 and not 60,000, okay, or 70,000, 90,000. So he has to convert his income on the basis of April to March every year. Okay, so have you understood this? Please have a look here. Is it clear?
Yes.
Because what we have done is we have tried to the assessor is making books of accounts on the basis of calendar year, and he is giving the breakup. So what we have done, we have used that breakup to calculate his income of the previous year. Okay, so that income tax recognizes only April to March and not the calendar year. So we have to convert the income which is given on the basis of April to March and then look for the relevant assessment year. Is this clear to everyone? Any doubt?
No, sir.
No, sir.
No, sir.
Chalo. Kishore, can you read?
Previous year in the case of a newly set up business, in the case of newly set up business or in the case of a new source of income, the previous year is determined as follows.
Okay, so previous year in the case of a newly set up business or profession. Suppose a person starts a new business. Okay, so what happens? First previous year.
First previous year. The first previous year commences on the date of setting up of the previous of the business, or as the case may be, the date on which the source of income newly comes into existence, and ends on the immediately following March 31st.
So he can start his business, any time during the year, but the close will happen on 31st of March. So the first previous year can be less than 12 months. Suppose a person has started the business this year on 1st of January, so he will have a 3-month period of first previous year. Okay.
Thus, in the case of newly set up business or new source of income, the first previous year is a period of 12 months or less than 12 months. It can never exceed 12 months.
So that means he's starting somewhere in the middle of the year. Okay. So his first previous year will be always either 12 months, full year. Suppose he starts from 1st April and ends up on 31st of March. So he'll have full 12 months, or he can start in the 1st of May, then he'll have 11 months. If he starts a business in the month of October, then it will have 6 months like this. Okay.
Second and subsequent previous year. The second and subsequent previous years are always financial years.
Okay. So next year there will be no issue. Always it will be from April, 12 months. Okay.
The second and subsequent previous years are always of 12 months. That is April to March.
Okay. Just read this.
When income of previous year is not taxable in the immediately following assessment year.
So these are exceptions. If you look at this, where I was talking about, I'm just going back to just read the last one. However, it is not necessary that one should maintain books. Okay, no, not this one. This thing, okay, income earned by individual will be taxable immediately following the assessment year. This rule is applicable in all cases except in few cases. So we will always have a previous year and an assessment year. Okay, so we know that concept now, but there can be exception to this rule. Okay, so let's understand what is that exception. Read this.
The rule that the income of the previous year is assessable as the income of the immediately following assessment year has certain exceptions. These are income of non-resident from shipping, income of person leaving India either permanently or for a long period of time, income of bodies formed for short duration, income of person trying to alienate his assets with a view to avoid payment of tax, income of discontinued business.
So under all these conditions, he will be assessed in the same year itself. So his previous year and assessment it will be same. Okay. For example, if he's doing a business of, he's a non-resident and his business is basically shipping, or a person who is leaving India permanently, okay, then he needs to be assessed in the same year before he leaves India. Incomes of bodies formed for very short duration. So such kind of businesses which are only for short duration, there also the income needs to be assessed in the year itself, in the year of the previous year itself. So in that case, the previous year will become the assessment year. Okay. Now, suppose somebody is trying to alienate his assets or destroy his assets, or trying to to avoid payment of tax. So in that case also the same rule will apply. So if you discontinue any business during the year, so in that case also your income can be subject to be assessed in the same year. Okay.
In this in these cases, income of a previous year may be taxed as the income of the assessment year immediately preceding the normal assessment year.
So in these cases, income of the previous year may be taxed as the income of the assessment year immediately preceding the normal assessment. That means the previous year and the assessment year will be same. Okay.
These exceptions have been incorporated in order to ensure smooth collection of income tax from the aforesaid taxpayers who may not be traceable if tax assessment procedure is postponed till the commencement of the normal assessment.
So this is basically to avoid such kind of a situation. The government doesn't want to lose money. So the condition which I have already shared, so in those cases, the person who is leaving India or, for other cases, they will be all taxed in the same year.
For detailed discussion, see problem 14P1. The financial year has a double role to play. It is a previous year as well as an assessment year. On the basis of the aforesaid discussion, it can be said that a financial year plays a double role. It is a previous year as well as assessment year.
Okay. Now I have there is some problem which given in the book, so you can just read the book when it comes. So I'm just not giving any problem, I suppose. So I'm just moving forward. Okay. So whenever you get a book, you can read this problem number P1 2.5. Okay. Fine. Okay. Read this.
Who are included in person? Section 231. The term person includes an individual, a Hindu undivided family, a company, a firm, an association of person or a body of individual, whether incorporated or not, a local authority, and every artificial judicial person not falling within any of the preceding categories.
So, under the income tax, all persons are supposed to pay tax. Now, who are all the persons? Individual. People like you and me. So, that's a simple case. Hindu undivided family. Now, there is something called HUF. For example, I have my HUF because, when my father or my ancestors, they died, they left some property. So, that belongs to my family. Okay. So, whatever income I derive from that property is the income of HUF. For example, I have a commercial property which is in name of my HUF. That means myself, my wife, my son, and my daughter. Okay. So we have a property which we have given it to, commercial property which we have given it to, for example, I have given it to Pizza Hut, and they are paying me a rent of 1 lakh rupees. So that money which I receive is the income of HUF and not mine as an individual. Okay. So it's called HUF. So we can understand more about HUF. You can always Google and understand more about what is HUF. That is, comes under the Hindu Succession Act. Okay.
So, sir, the tax structure of HUF is different.
No, actually, HUF is considered, yeah, definitely what you're saying is right. HUF is basically a separate legal entity and they are taxed separately. Okay. For example, I said, I have my own income. I'm a professor. Whatever income I draw, I'm taxed on that income individually. And whatever income I'm getting from the commercial property, which is owned by my family, it becomes the income of my HUF. So that means I have got two entities with me, one HUF, one individual. So that means it also helps you save your tax. If I would have not formed an HUF, then my commercial property income and my income would have been clubbed together and I had to pay a tax. So this is one way of saving income tax also if you have such kind of a situation in hand. Okay, is that clear?
Yes.
Then the third one is company. So company, like, we have companies registered under the Companies Act 2013, Reliance, Asian Paints, Infosys, all these are companies basically. Firm. So firm means partnership firms where, two or more people come together and start a business. Instead of forming a company, they form a firm and they become partners. An association of persons or a body of individuals, whether incorporated or not. So that means if suppose some people come together and form a society, like housing society or something like that, and they may or may not get themselves registered. Okay. Now all the associations or societies, they need to get themselves registered under the Societies Act, but it is not mandatory. Okay. So whether it is incorporated or not, it doesn't matter. So an association or association of persons will also be treated as entity for paying tax. A local authority like Municipal Corporation of Gurgaon or Municipal Corporation of Delhi, MCD. Okay, so these are local authorities. Every artificial judicial person not falling within any of the preceding categories. So any body or any judicial person which is created by the law. Okay, so we'll do some examples to understand what is the sixth G category. Okay, so example is coming in the next slide.
These are 7 categories of person chargeable to tax under the Act. Therefore, the definition is inclusive and not exhaustive. Therefore, any person not falling in the above mentioned 7 categories may still fall in the 4 corners of the term person and accordingly may be liable to tax under Section 4.
So the law says that these are 7 categories. There can be more categories which they couldn't put it in this section. So even if it comes out of this section, the 7 categories, they will be still regarded as person and tax will be imposed on them. So this is to make the law absolutely foolproof. If somebody tries to form a new thing which is not covered under the 7 categories, so he can't still avoid paying income tax, because even the definition covers any other body also which is not being written as in these 7 categories. So let's understand this. Okay, read this.
Determine the status of the following: Delhi University, DCM Limited, Delhi Municipal Corporation, Taxman Publication, Lakshmi Commercial Bank Limited, ABC Group Housing Cooperative Society, XY and Company, firm of X and Y, a joint family of X, Mrs. X and their sons A and B. X and Y who are legal heirs of Z. Z died in 1996 and X and Y carry on his business without entering into partnership.
So let's understand. A Delhi University, it is a artificial judicial person. Okay, so it's basically it is a body which has been created by the law. Okay, education law, whatever it is, and it is an artificial person because it is considered as a separate entity. So it is like it can function like a person. Okay. DCM Limited, a company. It's a company. Second, a Delhi Municipal Corporation, it's a local authority. Taxman Publication Private Limited, it's a company. Okay, the Taxman Publication is the company who has whose book we are reading at the moment. Okay, Lakshmi Commercial Bank, a company. AB Housing Cooperative Society, an association of persons. Okay, so this is a group housing society formed by certain people. So it's an association of person. XY and Company, firm of X and Y. So this is a partnership firm. So this is called XY and Company. It's not a company registered under the Companies Act, but there are 2 partners X and Y. So it's a firm, partnership firm. Then a joint family of X, Mrs. X and their sons A and B, a Hindu undivided family. 9. X and Y who are legal heirs of Z. Z died in 1996 and X and Y carry on his business without entering into any partnership. So it is an association of persons. So they have not formed a partnership, but they are doing some business together, okay, without forming a partnership or a firm. So in that case, it will be called an association of persons. Is this clear?
Yes, sir.
Okay. Read this.
Who is regarded as SSC? First category, a person that is an individual, a chief, a company, a firm, an association of person or body of individual, whether incorporated or not, a local authority, and every artificial jurisdictional person by whom any tax or any other sum of money, including interest and penalty, is payable under the Act, irrespective of the fact whether any proceeding under the Act has been taken against him or not.
So who is an assessee basically? There are various categories. The first category is he has to be a person. Okay. And we know there are 7 categories of person by whom any tax or any other sum of money, including interest and penalties payable under the Act. So that means the government, the income tax authorities have to collect, any sum of either interest or penalty or tax. Okay. So irrespective of the fact whether any proceedings under the income tax has been taken against him or not. So he will be regarded as an assessee. Suppose, this is called the first category. Second category.
SSC means a person by whom income tax or any other sum of money is payable under the Act. It includes. Second category, a person in respect of whom any proceeding under the Act has been taken, whether or not he is liable for any tax, interest or penalty. Proceeding may be taken either for the assessment of the amount of his income or of the loss sustained by him, or of the income or loss of any other person in respect of whom he is assessable, or of the amount of refund due to him or to such other person.
So, that means what he's saying is that, if any proceedings under the income tax, the first category, okay, the second category, a person in respect whom any proceeding under the Act has been taken. Okay, like income tax authorities are, entered into a proceedings to collect tax, interest or penalty. Okay, so then, he'll be called an assessee. Proceedings may be taken either for the assessment of the amount of his income or loss sustained by him. Okay. Okay, so we'll do some, illustrations before that, then we'll understand. So third category, read this.
Every person who is deemed to be an assessee, for instance, a representative assessee is deemed to be an assessee by virtue of section 162. Fourth category, every person who is deemed to be an assessee in default under any provision of the Act, for instance, under section 2011, and a person who does not deduct tax at source or after deducting fails to pay such tax is deemed to be an assessee in default. Likewise, under section 218, if a person does not pay advance tax, then he shall be deemed to be an assessee in default.
So that means, assessees can be either the assessees by themselves or they can be deemed to be an assessee. Okay. For example, the person is, every person who is deemed to be an assessee in default under any provision of the Act, for instance, a person who does not deduct at tax at source. Now, for example, so we'll understand all these through examples. Okay, then I'll explain. First, read this.
The following examples are given to clarify the above points. Income of X, age 35 years, is 2,50,000 for the assessment year 24-25. He does not file his return of income because his income is not more than the amount of exempted slab. Income tax department does not take any action against him. He is not an assessee because no tax or any other sum is due from him.
So that means if your income is below 2,50,000, now 2,50,000 is the up to 2,50,000, there is no tax in India. So if your income is below 2,50,000, you don't have to even file the return. Okay. If you don't file the return, income tax is not going to even, call you or will not take any action against you. So you are not an assessee in this case. Fine. So if your income is below 2,50,000, then you need not file your income tax return. You're not even an assessee. Income tax department will not even trouble you, and there will be no income tax due from you. Okay. Read this.
Income of Y, age 38 years, is rupees 2,55,000 for the assessment year 24-25. He does not file his return of income. Since he is supposed to file his return of income being more than exempted slab of 2,50,000, he is an assessee.
So your income is more than 2,50,000, but you have not filed your return. So you are an assessee. Okay, income tax authorities can always take an action against you. That is a different thing, but you will be considered as a assessee. Okay, fine.
Income of Z, age 51 year, is rupees 75,000 for the assessment year 24-25. He files his return of income even if his taxable income is less than 2,50,000. Assessment order is passed by the assessing officer without any adjustment. That is an assessee.
So you can even file your returns, like he's a 51 years old. So maybe that he was earning some income in the previous years. So this year his income was only 75,000. He still filed his income tax return. Okay. So he doesn't have to pay any tax. So he'll be assessed by the assessing officer by not raising any demand. So he will be still called an assessee. Okay, fine. So since you have filed the income tax return, the income tax officer has to still assess you and make an assessment for you. So in this case, you are still an assessee, though you are not supposed to file a return, but you have filed a return. Okay.
Income of A for the assessment year 24-25 is negative rupees 60,000. He files his return of income. He is an assessee.
So this person has negative income. Okay. Now, why do people file return if you are having a negative income? Because if you file the tax return next year when you earn income, okay,
Sure.
Next year suppose you earn 3 lakh rupees income. Okay, so you are supposed to pay tax. But then if you have a 60,000 rupees loss for the previous year, so that means your net income will be only 2,40,000. So you can carry forward the loss of the last year only if you have filed the return of the previous year. Is it clear to everyone?
Yes.
Yes, sir.
Suppose you have filed your income tax return in the year and you have made a loss. So after you have incurred a loss and filed your income tax return, now you are eligible to carry forward this loss in the next year. So next year, if you earn an income of 5 lakh rupees, so income will be treated as only 4,40,000. You can always claim 60,000 of loss. But if you have not filed your return, you will lose this loss. You cannot carry forward. So you will be considered an assessee. Okay.
Income of B, age 28 year, is less than 2,50,000 for the assessment year 25. He files his return of income to claim refund of tax deducted by X limited or interest paid to him. B is an assessee.
Now, sometimes people have, income is less than 2,50,000, but they still file income tax return because suppose they have a fixed deposit with the bank. Okay. And bank has deducted some tax at source, which is called TDS. So, banks, when you take a fixed deposit with the bank, if you are earning interest on a fixed deposit, after, a certain limit, the bank is going to deduct, say 10%, income tax on your interest income. So now you have to claim that refund of the interest which, has been deducted from your income. So you have to file an income tax return to claim the refund, okay, from the income tax authorities. So you are an assessee in that case. So just to explain you again, now, there are certain people whose income is less than 2,50,000, but they have, they have interest income. Okay. They have deposited some money in a fixed deposit with a bank like ICICI Bank or SDFC Bank. And if their interest income is beyond a certain threshold limit, then the banks are supposed to deduct income tax at source. Okay. Which is normally 10% of whatever income you earn. Suppose you have earned income of 1 lakh rupees as interest. Okay. Or your entire income of 2,50,000, suppose your earning is all interest. So you don't have to pay any tax. But 25,000 rupees tax you have paid because the bank has deducted 10% tax on your interest income of 2,50,000. So now you have to claim this 25,000. So you have to file an income tax return. So you will be considered an assessee. Is this clear?
Yes, sir.
Okay.
Income of C is less than 2,50,000 for the assessment year 24-25. He does not file his return of income during 23-24. He has paid salary of rupees 8,90,000 to an employee. Though he is supposed to deduct tax at source, yet due to ignorance of law, no tax is deducted by him. In this case, he is an assessee as he has failed to deduct tax at source. This rule is applicable even if his own taxable income is below 2,50,000.
Now, there is a provision which we'll learn later that, if, like, for example, when you work in a company, okay, like suppose, I'm associated with Shiv Nadar University, so I'm working as a visiting professor, so I get paid some money. So the Shiv Nadar University has to deduct tax at source from whatever they pay me. Suppose they are paying me, 5 lakh rupees. So they need to deduct 10%, which is called tax at source, and give me only 4,50,000 rupees. Okay. So that 50,000 will be deposited with the Government of India under TDS account. So I can always claim a refund if I don't have any other income. Okay. And I don't have to pay tax. So I can always, claim that as a refund by filing a tax return. Or suppose, like Shiv Nadar has deducted, tax, and they have not deposited the tax with the Government of India, then they will be still considered as assessee. Suppose, there is a person whose income is below 2,50,000, but he has paid salary of 8,90,000. He was supposed to deduct income tax at source. He has not done that. Okay. He can't say that I am, earning less than 2,50,000, so I have not to file an income tax return. Okay, he doesn't have to file, but he can become an assessee because income tax authorities will, file a claim against him that he has to, pay that tax which he has deducted and can impose some penalty on him. Is that okay?
Sir, even if the income is below the threshold or the exempted limit, the TDS is deducted, right?
This is the TDS for the other person, like suppose, I am a person C, my age is suppose say whatever 30 years, and my income is, below 2,50,000. Suppose I have hired you, I have hired Kishore, and I am paying income salary of 8,90,000 to Kishore. Then I am supposed to deduct income tax from the salary of Kishore and deposit that income tax with the government authorities. So if I don't do that, then I'll be, in this case, I'll become an assessee, and I'll deduct the whatever money which was supposed to deduct at source. I'll get an income tax notice from them. Okay.
So that is okay. I'm asking even if a person's income is less than 2,50,000 overall income, still the TDS is deducted?
No, not for him, but for the other person. Suppose I'm a businessman. Okay, fine. I have suffered a loss. Of course, I'm hiring people, so I have to do my duty. I'm paying salaries to the people. So if I say I'm suffering a loss, okay, I don't have to pay any tax. But for the others who are employed under me, I have to deduct tax from their salaries and deposit that money with the Government of India. So that law is that. Whether I am subject to tax or not, it doesn't make any difference. But if I am paying some money to someone, okay, suppose my income was 9.5 lakhs, and I pay salary of 8,90,000 to you. So my income is only just 60,000. So I don't have to pay any tax. But since I paid 8,90,000 to you, I have to deduct tax from your salary and deposit that money with the government. Is that clear?
Okay, sir.
Fine. So the taxability of the person doesn't immaterial, but whether he has complied with the rules of deducting tax at source or not. Like Shiv Nadar may not be making any profit, suppose in the next year, so they don't have to pay any tax. But they are employing so many people, so they are supposed to deduct tax from their salaries and deposit with the government authorities, okay, with the tax authorities. So that is what it says. Okay, read this.
How to charge tax on income? To know the procedure for charging tax on income, one should be familiar with the following. Annual tax. Income tax is an annual tax on income. Tax rate of assessment year. Income of previous year is chargeable to tax in the next following assessment year at the tax rates applicable for the assessment year. How to rates fixed by Finance Act. Tax rates are fixed by Annual Finance Act and not by the Income Tax Act.
So the tax rates are fixed by the Finance Act, which is passed every year. So income tax will not have any rates. Okay, just one or two rates have been given under the income tax for capital gains, but for all other taxes, the rates are given under the Finance Act. Okay, for example, there are certain rates which are given by the income tax, but they are hardly any. Okay, Like, if you are winning from a lottery or, this thing, so the tax rate is 30% or something like that. So that is given under the income tax. But all other rates are given by under the Finance Act.
For instance, tax rate for the assessment year 24-25 are fixed by the Finance Act 24.
Okay, so these rates will be fixed by the Finance Act 2024 for the assessment year 2024-25.
If, however, on the first day of April of the assessment year, the new finance bill has not been placed on the statute book, the provisions in force in the preceding assessment year or the provisions proposed in the finance bill before Parliament, whichever is more beneficial to the SSC, will apply until the new provision become effective.
So what happens when the finance bill is passed in in the Parliament? It has to first be approved by the Lok Sabha, then by Rajya Sabha, and then the President needs to give his accord. So after that, it becomes basically a Finance Act, and then it goes to the statute book. So suppose this procedure has not been done till the time, whatever is written there. So whichever is beneficial will be become applicable to the assessee. Okay.
Tax on person. Tax is charged on every person. Tax on total income. Tax is levied on the total income of every SSC computed in accordance with the provisions of the Act. Provisions as on April 1st of the assessment year applicable for computing income for the assessment year. Total income is calculated in accordance with the provisions of the Income Tax Act as they stand on the first day of April of the assessment year.
Okay, so that means if the whatever is the law which stands on the first day of April will become on which the tax will be collected from the SSC. Okay.
For calculating taxable income for the assessment year 24-25, the provisions of the Income Tax Act as on April 1st, 24 are applicable.
Okay, so that means the whatever was the income tax provisions which are applicable on 1st April 2024, they become for the purpose of taxing a person's law. Okay.
If an amendment is made with effect from April to 24 or any date after April to 24, it is irrelevant for the calculating income for the assessment year 24-25.
So if there is any amendment which happens on 2nd April 2024, that is, or any date after 2nd, so that means the rate on 1st April becomes the sanction date. So anything which is happening after, 1st or say 2nd onwards, it is irrelevant for calculating the income for the assessment year 2024-25.
Likewise, the law existing during the previous year 23-24 has no relevance for determining the total income for the assessment year 24-25.
So that means whatever the law which is applicable on 1st April 2024 will become the law on which the person has to be taxed. So anything prior to that or anything after that will have no meaning for levy of taxes.
The above rule is applicable only for the purpose of computing taxable income and not tax liability. However, an amendment is made in procedural law, not in substantive law, then it is applicable from the date of amendment.
Okay, so let's let's understand this. Okay.
Provisions illustrated. Consider the cases given below. Example 1 is on amendment in substantive law. Example 2, however, covers an amendment in procedural law. Rates, date and form numbers are imaginary.
Okay, these are very simple ones, so don't get, it's not a complicated thing. So let's understand. Suppose the now, can you read this, Kishore?
Suppose depreciation rate is reduced from 22% to 18% with effect from April 10, 24. For calculating income and income tax liability for the assessment year 24-25, the provisions of income tax law on the April 1, 24 is applicable.
Suppose there is an amendment which has come, the depreciation rate has been reduced from 22 to 18%, which has happened from 10th of April. Okay, then it will be 22% which will be taken for calculating your tax for 1st April 2024. Okay, read this.
On April 1, 24, depreciation rate is 22%. Consequently, income for the assessment year 24-25 shall be calculated by taking into consideration depreciation rate of 22%.
Okay. Now, for all the business assessees who are, doing business either in form of companies or in form of, profession or in forms of partnership. So they buy assets. Okay. So, they are eligible for depreciation. Okay, because the capital assets have generally a life of 5 years, 10 years. So they can't show that as an expense and reduce their income. So they can reduce their income only by way of depreciation. And depreciation rates are fixed by Income Tax Act. Okay. Now, suppose the depreciation rate was 22%, which existed on 1st of April. But on 10th of April, the depreciation rate has changed from 22 to 18%. This will be applicable for the next assessment year and not for the assessment year which we are talking. So the person has to claim depreciation at 22%. Okay, read this.
A new form U1 is introduced with effect from July 7, 24 for making application to the assessing officer for waiver of income tax penalty. This is an amendment in procedural law. It is applicable from the date of amendment. If an application for waiver is filed on or after July 7, 24, it should be submitted in the new form U1 regardless of the assessment year for which waiver is to be obtained.
So if there is a change in the form number, the form earlier the form number was T3, now it has become U1. Even it has happened in the current assessment year, so it will become applicable whenever you are filing your the form. So whatever is the latest one, you have to follow that because it is just a procedural law. But as far as the for example, the depreciation and other thing which is a substantial law, this needs to be followed. So this example is just to clarify. Okay, read this.
What is regarded as income under the Income Tax Act? The definition of the term income in section 224 is inclusive and not exhaustive.
So, what is happening is that what is an income? We are supposed to pay tax on income, isn't it? Under the Income Tax Act, we are supposed to pay tax under income. Now, income has been defined under section 2 of the Income Tax Act. Now, it is very difficult to define income. Okay, it's not such an easy thing. So they have just given some examples or some definitions under section 2, but which is inclusive and not exhaustive. So definition is just inclusive and not exhaustive. Even something which is not covered as an income can still be taxable under the hands of in the hands of an assessee. Okay, so section 2 is just basically giving some illustrations. In what cases the income tax will be levied on you. Okay, read this.
Now, therefore, the term income not only includes those things which are included in the section 2, but also includes such things which the term signifies according to its general and natural meaning.
So income, is very difficult to define. Okay, so government, the income tax authorities have defined the income under the section 2, but they say this is not exhaustive. This is just an inclusive definition. If anything else is also there, which will be considered as income, you have to pay tax on that.
Before discussing the definition of income given in section 2, it is imperative to know a meaning of income as generally understood.
So that means we should also, because the law itself says that section 2 is not fully exhaustive. So we must understand what is an income. Okay, in general sense. Okay.
Income is a periodical monetary return with some sort of regularity.
So income is a periodical monetary return with some sort of regularity. Suppose you are getting a salary every month, so it's an income. Okay, fine. So because you are getting you are earning that money every month, so it will be you have to pay tax on it. Okay.
It may be recurring in nature. It may be broadly defined as the true increase in the amount of wealth which comes to a person during a fixed period of time.
So this is the meaning of income in generally, what we understand that, it will ultimately, the income will increase the wealth of a person, because he's going to save some money out of that and his wealth will be created out of the income which he's earning.
Broad principles which clarify the concept of income.
Okay, so I'm just skipping this. So this is just, you can just go through. Okay, now this is the definition which has been given under section 224. Okay, so after this we'll have a break.
Under section 224, the term income specifically includes the following. Profit and gains. Income includes profit and gains. For instance, a profit generated by a businessman is taxable as income.
Now, what the income tax is doing is it is defining income, because income tax has to collect tax on your income. They say first is profit and gains. If you are doing business, then if you earn some profits, you have to pay a tax. Generally, a businessman earns income from profits and gains. So this covers majority of the businesses, basically all the businesses. Okay.
Dividend. Income includes dividend for taxability of dividend.
So if you have taken a shares of the company and the company is declaring dividend, so dividend will be taxed in your hands and it is an income.
Voluntary contribution received by a trust in the hands of a trust Income includes voluntary contributions received by it.
So now, they are trying to, include something else also. Okay, let's understand what is this.
XY Trust is created for public charitable purposes. On June 10, 23, it receives a sum of rupees 1 lakh as voluntary contribution, not being with any specific direction. From a business house, rupees 1 lakh would be included in the income of the trust.
Now, if suppose there is a trust, okay, there can be a charitable trust or there can be, any other trust, okay. So now it receives some money from a company, say 1 lakh rupees. So it will become their income of the trust and they are supposed to pay tax on that. Okay, fine.
Receipt versus accrual. Income arises either on receipt basis or on accrual basis.
Okay, so just hold on. Now, receipt can be either income arising on receipt basis or on accrual basis. So whether you have received the money, suppose I have sold some, goods to someone, okay. Suppose, I have given my services to, say, Shivnadar University. I have, taken lectures for the university and they were supposed to pay me 2 lakh rupees. And, it was, for it that I've given the services the last year and they're going to pay me in the next year. Okay, from anytime in the month of April or May. So I have to pay tax on that income for the previous year, but I'm getting my money in the next year. So that I have to pay tax on the accrual basis. So whatever money I've earned for the last year, whether I have got that money or not in the same year, doesn't matter. Okay, I may have got the money on 1st April this next year, but I have to pay tax on the previous year because that income will belong to me for my previous year. Okay, so that is what it says.
Income may accrue to a taxpayer without its actual receipt.
So, I have not received the money so far, but I have already given a lectures. Okay, but I'm getting my money only in the next year, but I have to pay tax in the year in which I have earned that money. Okay.
Moreover, in some cases, income is deemed to accrue or arise to a person without its actual accrual or receipt. Illegal income. The income tax law does not make any distinction between income accrued or arisen from a legal source and income tainted with illegally.
Even if your income is illegal, you have to pay tax. The Income Tax Act doesn't say that whether you have earned your money through legal sources or illegal sources. The law only will take any action against you. But since you have earned the income, okay, you have to pay tax. Now, income tax is not going. You are going to say this is illegal income, and I'm not going to pay tax on it. So the income tax will charge you tax even if it is an illegal income.
Disputed title. Income tax assessment cannot be held up or postponed merely because of existence of a dispute regarding the title of income.
Suppose, I have earned a rent on a property. Okay, the property is disputed by brothers. They say that, the property belongs to them. It is not my property. But it is currently I am getting the rental of the property. I have to pay tax on it. I can't say that it is a disputed title, so I will not pay tax on it. Okay.
Relief or reimbursement of expenses not treated as income. Mere relief or reimbursement of expenses is not treated as income. For instance, reimbursement of actual traveling expenses to an employee is not an income.
So, if I am getting a reimbursement, suppose I am, working in a company and company pays me, airfare to, go to some place like Bangalore for attending some of their official matters. So whatever money they are paying to me for, for my traveling or for my expenses, so that is only reimbursement of my expenses. So that will not be treated as income in my hand. So I don't have to pay tax on that. Is that okay? Okay. So now we are going to have a break. Okay. It's 10:55. So 11:15 we are going to meet. Is that okay?
Yes, sir.
Any questions?